For 24 years, you could not buy this company, not on any exchange, not at any price. Then last Friday morning, a small button appeared inside ordinary trading apps. It read, "Request shares." By the closing bell, one man had become the world's first trillionaire, and a company that lost nearly $5 billion last year was suddenly worth more than $2 trillion. The headlines called it the biggest moment in stock market history. But is that actually true? Did Main Street just buy a piece of the future, or pay a premium for a promise that is still years from arriving? I'm Ori Kalem. I dig into the facts about money that most people walk straight past. Today, the SpaceX listing and what it really means for the small investor, not the headline writer. 3 things today. 1. What actually happened on that trading floor. 2. Why a company losing billions is worth trillions. 3. The quiet machinery that moved your money even if you never pressed that button. Stay with me to the end. This changes how you see it. Before we start, one fact to anchor everything. SpaceX stayed private for 24 years. Most giants go public far sooner. Why does that matter? Because the longer a company waits, the more pressure builds behind the door. So let's open it. On the 12th of June, SpaceX began trading on the NASDAQ under the ticker SPCX. The price was set at $135 a share. At that price, the company raised about $75 billion. Reuters reported this made it the largest initial public offering ever recorded. Why does $75 billion matter? Because the previous record, Saudi Aramco in 2019, raised about $35 billion. Why was Aramco the benchmark to beat? Because it was a national oil giant, the kind of asset that rarely comes to market. SpaceX more than doubled it. Then the shares started trading freely. They did not stay at 135. By the closing bell, CNBC reported SPCX finished near $161, up about 19% in a single day. Why did it jump the moment trading opened? Because the set price was decided by banks beforehand. The open market then votes with real money. That 19% was the crowd saying the banks priced it too low. That surge pushed the company's value past $2 trillion, and on paper it made Elon Musk the world's first trillionaire. One listing, one afternoon, a number with 12 zeros. But here's the simplest way to picture an IPO before we go further. Think of it like this. For years, a famous bakery only sold bread to a private club. Venture capitalists, big funds, insiders. You could smell it from the street, but you could never buy a loaf. An IPO is the morning that bakery finally opens its doors to the public. The initial public offering simply means the first time anyone can buy a slice of ownership on the open market. That's exactly what happened here. After 24 years, the rope came down. And this opening was unusual in one specific way. Normal IPOs reserve maybe 5 to 10% of public shares for everyday people. The rest goes to large institutions. SpaceX, by several reports, set aside as much as 30% for individuals. Why is 30% so unusual? Because it flips the normal order. The good seats usually go to the giants first. Here, the door opened wider for the ordinary investor than almost any mega-listing before it. That single choice is why the button appeared in your app at all, and demand was fierce. Reporting suggested the offering was more than twice oversubscribed, roughly $150 billion in orders chasing a $75 billion raise. Why does that gap matter? Because when orders outrun supply, most people who request shares simply do not get them. But that's not the end of it. Because the more interesting question isn't who got in, it's what they actually bought. So here's what actually matters. When you buy this one share, you are not buying a rocket company. You are buying 3 very different businesses bundled together. and they could not be more different in how they make or lose money. The first business is the rockets. The Falcon launches the Starship program. According to the company's own filing, this space segment brought in about $4 billion in 2025, but it ran at an operating loss. Why does the rocket business lose money? Because the company has poured the cash back into the next machine. The filing disclosed more than $15 billion spent developing Starship alone. The launches you see are not yet the profit, they're the investment. The second business is the one that actually pays the bills. Starlink, the satellite internet network. Per the prospectus, Starlink generated about $11.4 billion in 2025. That's roughly 61% of all revenue. And unlike the rockets, Starlink turns a profit, about $4.4 billion in operating profit on more than 10 million subscribers across more than 160 countries. Why is a subscription so powerful? Because it pays every single month, like rent. Predictable money is the most valuable money a company can own. There is one quiet warning sign, though. Reporting noted average revenue per subscriber slipped as the company chased global volume, then began nudging prices back up in 2026. The third business is the newest and the strangest. In early 2026, the company folded in xAI, the artificial intelligence arm, which also absorbed the platform once called Twitter, and this is where the losses live. How much does it drain? Reporting put the AI segment's operating loss above $6 billion in 2025. Why so much? Because building artificial intelligence means buying mountains of expensive computing hardware before earning a cent back. The profitable satellite business is effectively paying for the hungry AI business. Think of the whole company as one body. Starlink is the beating heart. It pumps the cash. The rockets are the legs, expensive, slow, but carrying everything forward. And the AI arm is a brand new brain, drawing enormous energy before it can think a single profitable thought. Put it together, and the picture sharpens. In 2025, the company reported total revenue of about $18.7 billion, up a third from the year before. Strong growth, but it also reported a net loss of nearly $5 billion. Here's where most people get confused. Now you might be thinking, if it loses money every year, how can it possibly be worth nearly $2 trillion? It's a fair question, and the answer is the whole game. A company's price is not paid for last year's profit. It's paid for the future people believe is coming. Analysts noted the stock came to market at roughly 94 times its annual sales. On any traditional measure, that is extraordinarily expensive. Why would anyone pay that? Because they are not buying $18 billion in sales. They are buying a bet that Starlink keeps growing, that Starship works, that the AI arm one day turns its losses into a profit engine. The price is a wager on a future that has not arrived. And here is the uncomfortable part. If even one of those three bets disappoints, the price has a very long way to fall before it meets today's actual earnings. Now, blind optimism is dangerous. Let's check the other side honestly. This is analysis, not investment advice, because a price built on the future has a fragile floor. But don't get carried away. Let's be objective about the risks. Risk 1, that 94 times price assumes near flawless execution. If growth slows even a little, a high multiple can contract violently. The same number that lifts a stock fast can pull it down just as fast. Risk 2, the AI losses are still growing, not shrinking. Reporting showed the loss accelerating into early 2026. Why is that dangerous? Because the profitable part of the company is being asked to carry a heavier and heavier passenger. Risk 3. Only a tiny sliver of the company actually trades. The public float was reported at just a few percent. Why does a small float matter? Because when very few shares change hands, the price can swing wildly on small amounts of buying or selling. Thin ice moves under the lightest step, and risk 4 sits on the calendar. Insiders and early investors are often locked from selling for a set period after listing. When that lock expires, likely later this year, a wave of long-held shares can hit the market at once. Some analysts are already circling that date. This is how the big money, the smart money, actually reads it. The institutions are not arguing about whether it's a great company. They're arguing about the price and about timing, and there's a mechanical force most people never see. An index provider, MSCI, moved to add SPCX into its indexes the day after listing. Why does that matter to you? Because funds that track those indexes must then buy the stock, not because they chose to, but because the rules require it. That forced buying was estimated in the billions. So even people who never opened a trading app may now own a slice of this rocket through a pension or a retirement fund quietly tracking an index. The button may not have been yours. The exposure might be anyway. Why does this happen automatically? Because index funds promise to mirror an index exactly. When the index adds a name, the fund must add it too. No human decision involved. But notice the limit. The S&P 500, the index many retirement savings follow, kept its rule requiring recent profitability. SpaceX, with its loss, did not qualify for automatic entry there. So the exposure is real, but it is not everywhere. And not everyone is cheering. A prominent U.S. Senator, Elizabeth Warren, responded to the listing by calling for a wealth tax and stronger due diligence checks from regulators. The scale of one person's paper fortune has reopened an old argument about who these markets serve. Don't overcomplicate it. Hold one realistic picture in your head. You're looking at a profitable internet business strapped to an expensive rocket program and a cash-burning AI lab sold at a price that assumes all three win. But step back. There's a bigger picture worth seeing here. This was never just about one rocket company. Reporting suggests 2 more giants, OpenAI and Anthropic, are preparing to go public in the coming months. Why does that matter for everyone, not just buyers of this stock? Because when enormous new companies list, investors often sell other shares to raise the cash to buy in. That selling can ripple across the whole market, moving prices in stocks you already hold. One listing can tug the entire board. 3 checkpoints to watch. Just 3. First, the company's first public earnings report, expected later this year. That's the moment the promises meet real, audited numbers for the first time. Second, whether Starlink keeps growing subscribers and protects its profit. That is the heart that pays for everything else. Third, whether the AI losses start to narrow or keep widening. Those 3 signals will tell you if the bet is turning real or turning thin. If you remember one thing today, make it this. A record-breaking price is not the same as a record-breaking bargain. The biggest IPO in history is also one of the most expensive, and the door that opened wide for ordinary investors swings both ways. I'm not here to tell you to buy it or avoid it. I'm here so that whatever you decide with your eyes open, knowing it's 3 businesses, 1 promise, and a price paid for the future. The crowd that pressed that button on Friday was buying a story. Stories can come true. They can also take far longer and cost far more than the price assumes. If this made something click, a like genuinely helps. What are you watching right now? Tell me below. I read them. This has been the Vault Bureau. Mind how you walk past your money. I'll be here when the next door opens.